See if this works. Purchase equipment. For $6,000. What'll the entry be? Equipment goes up. So we make equipment go up by debiting it. And what goes down? We make cash go down by crediting it.
Wait, so when someone online asks a question, does it come through?
We should get it. Oh, so you heard it. Yeah, everything you said, we heard.
Maybe they should put the mic until they're ready to ask a question.
I don't think they can.
Can we mute them?
Wait, tell them.
We need to mute their microphone.
They're just gonna come back.
I know, right?
They have to mute whatever.
Did it go away?
Yes, sir.
There it is.
No, I had muted it just to see to make sure I had it. Okay, so we've muted a bunch of people video conferencing.
Thanks.
Alright.
Paid first month's rent of $500. Credit cash, okay. So we'll start out with the credit to cash.
Debit rent expense.
Debit rent expense. We provide services to customers and bill $4,000. Debit accounts receivable.
And credit revenue.
Debit accounts receivable. And credit revenue. Then we collect $2,000 of the accounts receivable owed to us.
Debit cash, credit accounts receivable.
Question. Even though it's cash, and it's from accounts receivable, would we annotate that to be more specific with regards to revenue? It was listed revenue earlier, so it would credit debit revenue.
Where was revenue earlier?
Well, accounts receivable is 4,000, and then revenue is 4,000.
Right?
If we collect half of that of the accounts revenue receivable, will we then debit revenues? No, never mind. Because we haven't earned anything new. It's now it's a cash coming in. Sorry.
Right. The revenue is what we've earned. It's irrespective of whether we got paid for it. The receivable will track the payment and how much we're still owed. So once we record the revenue, what happens with the cash has nothing to do with it. We pay our staff $3,800 in salaries.
Credit cash.
Debit salary expense. Okay, debit salary expense, credit cash.
Everybody got the feel for how this is working? So we're going to start again, and we're going to take a little bit longer example. Only we're going to take it, we're going to make the transaction, we're going to record the journal, then we're going to post it to T accounts. We'll use those numbers to balance the T accounts, take a trial balance, then make the financial statements. So in a simple way, we'll go from beginning to end. So the name of the company is Sophie Catering, Inc. Business starts January 1st, 2015. I'm going to number each of the transactions because when we post them to the T accounts, I'll put the number on it so we'll be able to trace back if we need to. So the business starts by issuing 10,000 shares of stock for $20,000. What would the entry be?
Debit cash.
Debit cash and credit common stock or debit common stock?
Credit.
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 So we hire an admin assistant and we agree to pay her $2,000 for 2 weeks. What would the entry be?
Credit cash and salary expense.
Okay, anybody else?
Debit prepaid salary, credit cash.
Okay, another possibility? This one's actually no entry. We're missing the magic words paid. Generally, no cash changes hands until we see paid or received. So in this case, we hired somebody, but until they've worked, we haven't incurred an expense. If it said she worked for 2 weeks and we owe her $2,000, then it would be debit salary expense, credit salaries payable. If we paid her $2,000 for the 2 weeks, debit salary expense, credit cash. But just hiring her at a salary of $2,000 for 2 weeks isn't an entry yet. We rent a building for 3 years, so we sign a 3-year lease. The rent is $500 a month, and we pay for 6 months. And we should note we're doing the first month's financial statements. So we're doing the month of January. So what would the entry be? Well, what did we pay? How much did we pay in total?
3,000.
3,000, 6 months at 500. So what would we do with the 3,000?
Credit cash.
Credit cash, 3,000. Now, how about the debit side?
Account payable.
Well,
Rent expense.
Rent expense. How much to rent expense?
500.
For 1 month, 500.
2,000 to 5. Prepaid. Nice.
Is it possible to break this up into 2 separate journal entries? To record the prepaid?
I say you shouldn't.
You shouldn't.
You shouldn't.
You shouldn't.
Shouldn't. You can, but you shouldn't. And here's the reason why. We're going to post these entries the way they appear here. When I look on the bank statement to match to my records, I'm not going to see a check for 500 and a check for 25.
No.
I'm going to see one check for 3,000 coming out of my account. So I want that
It's
number
easier
to
to reconcile if you keep it.
Yeah, now reconcile is a concept we haven't gotten to yet, but that's why I like to post it the way I'm going to see it. Theoretically, you'll come out to the same correct financial statements.
It's just easier in reconciliation
Yes.
processes.
We haven't mentioned prepaid rent yet. Prepaid rent, prepaid expenses, these are expenses that we've paid for, but we haven't used up. We're going to use them up as periods go by. If we were doing an annual financial statement, not a monthly financial statement, we could have called all of it rent expense, because it'll all be expense over the next 6 months. But for 1 month, only 500 is expense. The rest has been prepaid for the next 5 months. Purchase equipment. For $5,400. Credit cash for $5,400. And what do we debit?
Equipment assets.
Quick. Accountants aren't the most creative of people, so generally the words we use in the transaction are the words we're going to use to call the account. We purchase equipment, we call it equipment. We don't really get too fancy with this stuff. We provide services to customers for $5,000 on account. Whenever we see on account, it means either we're billing somebody or we're getting billed. It means we didn't pay for it or get paid.
Debit account receivable.
Debit accounts receivable. And credit revenue. We purchased $1,800 of supplies on account.
Debit purchases according to the goals payable.
Yeah, I would call it supplies though. Provide services to customers for $7,800 cash.
Credit revenue, 7,800.
Credit revenue,
Debit services. Debit services.
Cash.
no, cash, because we got paid cash. Paid employee salaries, $5,200.
Debit salary expense.
Debit salary expense,
Credit cash.
credit cash. We paid $1,000 towards the accounts payable in item 6. Credit cash. Debit accounts payable. We received 4,000 of the accounts receivable owed from 5.
Debit cash. Credit AR.
Paid $800 for advertising.
$800 advertising expense.
Cash.
Paid the January utility bill of $1,300. cash.
Debit utilities.
I would make it utility expense. So when in doubt, take the word and add expense at the end. Not always right, but if you're stuck, it's a little safer. Okay, any questions about the journal entries? We have the transaction, we made journal entries, now we're going to post. Has anybody heard the word general ledger before? You know what it is?
It's a summary of all.
It's a collection of your T accounts. All your T accounts collectively form the general ledger. All the accounts we've created through our journal entries, T account for each one. You can order them any way you like. I prefer to do assets, liabilities, equity, revenues, and expenses. Some people like to do revenues, expenses, assets, liabilities, equity. Generally, it makes sense to keep similar accounts together. Now, if we go through each of our journal entries, the first journal entry, and I'll put one in a circle to reference journal entry 1, was a debit to cash for $20,000 and a credit to common stock. Journal entry 2 was no entry, so we don't put that anywhere. Journal entry 3 was a credit to cash, a debit to prepaid expense, and a debit to rent expense. Journal entry 4 was a credit to cash, and a debit to equipment. Journal entry 5 was a debit to accounts receivable. And a credit to revenue. Journal entry 6 was a debit to supplies and a credit to accounts payable. Journal entry 7 was a debit to cash and a credit to revenue. Journal entry 8 was a credit to cash and a debit to salary expense. Journal entry 9 was a credit to cash and a debit to accounts payable. Journal entry 10 was a debit to cash and a credit to accounts receivable. Journal entry 11 was a credit to cash and a debit to advertising expense. And journal entry 12 was a credit to cash and a debit to utility expense. Now, in the event you're far behind, I'll give you a couple more minutes, but I'm going to post the whole thing to Blackboard. So if you want to keep going and write it down, that's fine. But if you miss some, it'll be on Blackboard for you. So the next stage is balancing. Balancing is adding up all the debits, adding up all the credits, subtracting the two, and putting the difference on whichever side is bigger. So all the debits are 31.8, all the credits are 16.7, the difference is 15.1. In some cases, we don't have to do anything. So we have cash 15.1, accounts receivable 1,000, prepaid expense 2,500, supplies 1,800, equipment 5,400, accounts payable 800, common stock 20,000, revenue of 12.8, rent expense 500, salary expense 5,200, advertising expense 800, utility expense 1,300. The next step is to take a trial balance. A trial balance is just a list of all these accounts and whether it's a debit or credit balance. Trial balance has 3 columns, one for the account and one for either a debit or a credit. Debits are abbreviated DR, credits abbreviated CR. So the accounts are cash, accounts receivable, prepaid expense, supplies, equipment, accounts payable, common stock, revenue, rent expense, salary expense, advertising expense, utility expense, and then total. So cash was 15,100. Accounts receivable was 1,000. Prepaid expense was 2,500. Supplies were 1,800. Equipment was 5,400. Accounts payable was 800. Common stock was 20,000. Revenue was 12,800. Rent expense 500. Salary expense 5,200. Advertising expense 800. Utility expense 1,300. Total debits 33,600. Total credits 33,600. So the trial balance balances. Does that mean it's correct? No, it doesn't mean it's correct. All it means is it balances. Well, let's take an example. Suppose I put the accounts payable 20,000 and common stock 800. Does it still balance? Yeah, it does, but it's not correct. I will say if it doesn't balance, it can't be correct. Because it does balance, it might not be correct. But that's certainly the first step to being correct, is having it balance. Now, sometimes it won't, especially if you're doing list of numbers manually. Has anybody heard of something called a transposition error? What's a transposition error?
Incorrectly entered information.
Specific type of incorrectly entered information. It's where you take two adjacent numbers and flip them. Krista, pick a number up here.
1,800.
1,800. So a transposition error would be to make that 8,100. We flipped the 1 and the 8. We could have flipped the 8 and the 0 as well. If we make that 8,100 instead of 1,800, what happens to total assets, total debits? Goes up by how much? Not 8,100, because we have 1,800 in it.
No, it's a difference. It's a difference.
It goes up by 6,300. So 63 is 39,900. Is that right?
Yeah.
Okay. So now we have debits of $39.9 and credits of 33 cents. Can this be right? No, there's a problem with our trial balance. We're going to try to figure out what that is. There's three common errors we're going to look for. The first is a transposition. The way to find the transposition is take the difference between these two numbers. The difference between these two numbers is $6,300. A transposition error is always divisible by 9. So if we divide that by 9, what do we get?
700.
700. So does it mean it's a transposition error? It doesn't mean it, but it means it can be. So that's the first place we're going to look. But we're not going to shoot in the dark. This 700 tells us a couple of things. The 7 tells us the numbers that were flipped differ by 7. 1 and 8, 2 and 9, 0 and 7. Those are the possibilities. So we're looking for two numbers adjacent to each other that differ by 7. And the two zeros tell us we're looking between the hundred and the thousands place. So we start at the top and we look for two numbers next to each other that differ by 7. Here we have 1 and 5, 5 and 1, 1 and 0. No. 1 and 0. No. 2 and 5, 5 and 0. 8 and 1. That's possible. And they're in the right spot. 5 and 4 don't work. 4 and 0. 8 and 0, no. 2 and 0. 1 and 2, 2 and 8, 8 and 0. We go down the list. The only possibility is the 8100. It's a lot easier to identify the number using the difference and the places you're looking for. So doing that, we can fix this. Second most common error is you put something in the wrong column. We're going through listing all the assets, equipment 5,400, accounts payable 800. We list it as a debit accidental. So what happens? Our debits go up by 800. Our credits go down by 800. So the difference between the two is 1,600. What's the most common error? Transposition. So the first thing we do is we divide this by 9. Does it evenly divide by 9? No. So it can't be a transposition error. The next most common is we enter something in the wrong column, in which case the effect will be doubled. So we want to divide it in half. So now we're looking for $800 in the list. We have one item, so we'll check to see did we enter it correctly. It's accounts payable, so the answer is no. Doesn't belong in the debit column, it's a credit. So we can fix that.
Can you repeat what that's called, please? That second error?
Oh, the wrong column error. There's no fancy name for it. The third type of error is we left something off entirely. We just forgot to put the number on. In which case, credits will be the same, but the debits will be $5,400 less. So what we want to do is we want to subtract the two. We get 5,400. Is that divisible by 9?
Yeah.
It is. So we get 600. So now we're looking for two adjacent numbers that differ by 6. 1510, no 10, 25, no 50, 1880, 8020. Well, here we go. And that's the only possibility. So we're off because debits are less than credits. So if we flip the 8 and the 2, what happens to credits? Well, it becomes, instead of 12.8, it becomes 18.2. So this number goes up. So that's not the transposition we're looking for. It makes our difference worse. Even though it's in the right place and they're the right two difference, the numbers differ by the right amount, that's not a transposition we're looking for. So it's not a transposition. We could take the 5,400 and divide by 2 and get 2,700. See if 2,700 is in the wrong column. Are any of these numbers 2,700? Nope. So it's not a number in the wrong column. So the last possibility of common mistake is we left $5,400 off the schedule. So we go back to our T accounts, the general ledger, and we go through every one, and we see that we left equipment off. And we're back in balance. Now, I started in accounting before there were computers. No spreadsheets, nothing automated. Just, we had these green pieces of ledger paper with these little boxes on it. We wrote in the numbers, and we had a 10-key adding machine. And if we found a mistake, I didn't have these tools when I was trying to find out why my numbers didn't work. And the more you look at the numbers, the more you're going to see what's supposed to be there instead of what you wrote down. If you don't catch it on the first pass, you will never catch it. You could spend all day. What you need to do is have someone come over. The disadvantage is when they come over and find it in 1 second, you want to strangle them. This technique works fairly well. But it's amazing how you'll see the right number even though the wrong one's written down and the wrong number's in the total. This makes it a lot faster to find errors. With computers, really what we're doing here, computers are going to do for us. Once we put in the debit and the credit, it's going to post it, everything will flow through automatically. But you have to know what's going to happen for when something goes wrong or something doesn't work to find your error. If you don't know what's happening inside the machine, you can never reconcile problems. So we have our trial balance. It balances. We're fairly sure everything's correct. Now we want to make our financial statements. What's the first statement we're going to make? The income statement. Now, a trial balance is an internal document. It doesn't have to be properly formatted and properly labeled. It makes it a lot easier if it is, but it's not a requirement. Financial statements are going to be given to outsiders, they're for the public. Everything has to be properly prepared about them. So we're going to start off with the title. Sophie Catering, Inc. Income statement. For the month ended 1/31/15. What goes on the income statement? Revenues and expenses. So we have revenue of $12,008. Our expenses are rent, salaries, advertising, and utilities. So total expenses are 7,800. Net income is 5,000. There are some things about formatting that are important. There are some things that are not. I usually start with a dollar sign and end with a dollar sign and don't put dollar signs in between. Whether you indent a little bit under expenses or don't is personal choice. A single line means a subtotal. And then another line here means a subtraction. If you skip a space and don't put that bottom line in, that's fine. The double underline means the end of the statement. So the lines, the single and the double, do have some information. Dollar signs, not so important. Indenting, not so important. As long as it's clear where the totals come from, the subtotals and totals come from. What statement should we do next?
Balance sheet.
Not quite. Statement of retained earnings. So it's the name of the company, name of the statement. The statement of retained earnings uses the same period as the income statement. Since this is the first month of the company's operation, the beginning balance is 0. Net income is 5,000. Nothing in dividends were paid, so the ending balance is 5,000. Another convention that really doesn't matter is anything that's 2 words, only the first word has a capital. Second word is lowercase. So accounts receivable, A is capitalized, R is lowercase. That's just style. It really doesn't affect the user experience or understanding, so I'm not picky about that. Now what statement do you want to do? One left. The balance sheet. What am I going to write underneath balance sheet? As of
131.
131.15, or what's another acceptable version? As on. And lastly, $131.15. That works also. In each of those 3 cases, as of, as on, or just 131.15, do you know when the period began? No.
Doesn't matter.
It matters that you not know. If you can tell when the period began, it's wrong. It has to be referred to in a way that you can't discern when the period began. So as of, as on, or simply 130, 115. I'm going to start with the assets. We have cash, accounts receivable. Prepaid expense, supplies, and equipment. So that gives us total assets of 25.8. Now we have liabilities and equity. Liabilities, we have accounts payable of 800. We have equity, common stock, and retained earnings. We're going to have total equity, and then total liabilities and equity, 25.8. Since we only have one liability, I don't need to subtotal it. I don't like to show the number again as a subtotal. I just leave it like that. But since we have two items of equity, we have to show the total for equity. And then we show total liabilities and equity, and that should equal total assets. Any questions about this?
What is the rule regarding the use of supplies as a capital asset as opposed to resource?
The rule is all the textbooks make it an asset and they show usage over time. In real life, when we're talking about supplies, we just make it an expense. But if we're going based on the way the book does it, they would call it an asset. If I had 1,800 in supplies, I would just make it expense. So here we have our three statements. There we have our trial balance. Where is retained earnings on the trial balance?
Are you asking for this period or generally?
For that trial balance,
The whole bottom portion.
the whole bottom portion. Really, we could have put this account on and put a 0 there. Because the trial balance shows the beginning balance of retained earnings. It has all the debits and credits for the year. Now, what happens at the end of the year? December 31st, well, in this case, January 31st comes, we make our statements. Now we start February. What happens in February if we want to restart and have monthly financials? What happens to our revenues and expenses? It's like January 1st on your pay stub. Your year date goes back to 0. So when we start a new period, we get rid of our revenues and expenses. Are we still in balance? No. How much are we out of balance? Well, right now, credits are $20,800. What are debits going to be? $20,500, $21,500, $21,600, $23,600. 0. That looks like $25,800. So we're out of balance by $5,000. Debits are more than credits. And that's because after we restart the period, the difference between revenues and expenses becomes retained earnings. So retained earnings is now ready to start the next period. Beginning retained earnings on February 1st is the ending retained earnings from January 31st. So that's 5,000, and our trial balance again balances. We used to teach a closing entry. The closing entry is you debit the revenue, you would credit the expenses, and the difference goes to retained earnings. So we would have debited revenue for $12,800, we would have credited rent for $500, credited salaries for $52, credited advertising for $8, credited utilities for $13, and we would have needed a credit to retained earnings to balance that closing entry. And so we would have put the net income in retained earnings, which now makes retained earnings the ending balance. And we would erase all the revenues and expenses to start the next period. Did that help?
Yeah. So retained earnings is, you said it's the difference between your debits and your credits at the end of the period?
Of revenues and expenses. Because these don't get touched, only below here. So at the end of the period, when we've made our statements, we erase revenues and expenses. When we do that, we no longer balance. That's because we have to put that difference, which is net income, into the new beginning retained earnings. When we started the statement, retained earnings was 0, because that was the beginning balance. Once we've done everything, this now becomes the ending balance, and we erase revenues and expenses. Any questions about this, or can I erase it? The first book I wrote was called Accounting Demystified. It was like a basic accounting book. And I had 3 children at the time, so I used all their names in the companies and their birth dates with the statement dates. Then I had a 4th child who got very upset she wasn't in the book. Well, you weren't born yet. I couldn't put you in the book. So I wrote another book called What If Everything We Knew About Investing Was Wrong? And I made sure I used her name prominently. And it kind of just satisfied her for a little bit. So I'm hoping this one gets me over the hump in not using her name. So let's do the assignment that we had for homework. Does anybody need a syllabus? Course outline?
Just one online.
It's on Blackboard, but I have, one extra if anybody wants it. So we had 4 exercises, 6, 7, 8, and 9. Oh, did I?
Yeah.
6?
I think. Or maybe not. I don't know. You did something.
All right, well, we'll do it again if we did it right. Exercise 6, below is a list of common accounts. Indicate whether the normal balance of each account is a debit or credit. Now, what is a normal balance? A normal balance means what you expect to find. So if we're thinking of cash, the normal balance for cash is a debit. We usually expect cash to have a debit balance, positive balance. Accounts payable, we expect to have a credit balance. So if we look at our list, wherever the plus sign is what we expect the normal balance to be in most of those accounts. And not everything I say will be the truth at the end of the semester or the trimester. But for now, if it's a plus on the left, then the normal balance is a debit. If a plus is on the right, the normal balance is a credit. So cash, normal balance, a debit or credit? Debit. Service revenue. Salary expense? Debit, right? Expense, debit. Accounts payable? Accounts payable, credit. Equipment? Debit. Debit. Now, you're not always going to have that up there. But for today, it's okay. Maybe next time, too. Retained earnings? Credit. Yep. Utility expense? Debit. Expense. Yeah. Apparently having it up there isn't helping so much. Accounts receivable. Debit. Accounts receivable is an asset. Dividends. Debit. Now there's 2 types of dividends. Just the account dividends, which means dividends paid, and dividend revenue, in case you collect dividends. In this class, whenever we see dividends, we mean the dividends we pay to the shareholders. So that'll be debit. Common stock. Credit. Okay, then we have some transactions, and we just have to say the accounts that are debited or credited. Pay a cash dividend. Well, what does pay mean? What are we going to do to cash? Credit cash. So what are we going to debit?
Account payable.
Pay a cash dividend. We're going to debit dividend, credit cash. Pay rent in advance for the next 3 months.
Delivery expense for 1 month.
No interest.
And the rest of it for prepaid.
We'll start with the easy part.
Well, credit cash.
Credit cash. Then debit rent expense.
Debit rent expense for 1 month, and then debit prepaid rent expense for the following 2 months.
So it's either, exactly right, or debit prepaid expense for 3 months, depending on what they mean. Yeah, so it's either 1 month expense, 2 months prepaid, or 3 months prepaid. Provide services to customers on account.
Revenue credit.
Revenue credit. Debit accounts receivable. Purchase office supplies on account.
Credit cash.
On account, doesn't say pay. Account means no cash.
Credit accounts payable.
Credit accounts payable.
Debit purchases.
Not purchases.
Supplies or whatever.
Supplies, office supplies, yeah. See, purchases is going to be something that's going to be a specific account that we're going to be using much later. So we don't want to use that to mean purchases because we purchase things. What did we purchase? Well, office supplies has its own account. Pay salaries for the current month.
Salaries credit. Salaries credit.
No.
No, credit cash.
Cash.
Credit cash.
Yeah,
Debit
salaries.
Debit salary expense. Issue common stock in exchange for cash. Debit cash. Credit common stock. Collect cash from customers for services provided above.
Debit cash.
Debit cash. Credit,
Credit account payable.
not payable, receivable. Borrow cash from the bank and sign a note.
Cash credit.
Cash,
Credit.
cash,
Debit.
debit. We borrowed money, so we got cash from the bank. And we gave them a note,
Account payable.
not account payable,
It's a liability, so I guess it's.
something payable. What'd we give them? A note,
No payable.
no payable. Pay for the current month's utilities.
Credit cash. And utility expense.
Debit utility expense, credit cash. Pay for the office supplies purchased above.
Credit supplies.
Supplies debit and credit cash.
Credit cash, debit,
Supplies.
not supplies. We already bought the supplies.
Account payable.
Accounts payable. Okay. So there are some pairs we have to get used to using. Mostly we're talking about businesses. When we go around and buy stuff as individuals, there's very few stores we walk into that give us credit. We walk in, we expect to pay for it. Whether we give them a check, we pay cash, or we swipe our credit card. Businesses tend to be billed. They order something, they get a bill, they have a period of time to pay for it. So we're thinking in terms of payables and receivables for most things. So AR and revenue are going to go together. Debit expense, credit accounts payable is going to work together. When we get paid, we debit cash, credit accounts receivable, and we pay for something, we debit accounts payable, we credit cash.
What Kiwi just said. The last one.
The last one?
When you purchase something,
We buy something, we record a payable. When we pay for it, we debit the payable, we credit cash. So we buy something, we get a bill for something, it's debit expense, credit accounts payable. We make the payment, it's debit accounts payable, credit cash. These pairs come up a lot. Not every single time, but most of the time. Exercise 8. We have the following transactions. And we have to make the entry. Purchase equipment in exchange for cash, $23,400. What did we get? So we're going to do what to equipment?
Debit.
Debit, right? It's an asset. And so to increase it, we need to debit it. What did we give up?
Cash.
So how are we going to record the cash? Credit. So debit equipment 23.4, credit cash 23.4. Provide services to customers and receive cash of 6,800.
Debit cash.
Debit cash 6,800. Credit,
Accounts.
not accounts receivable.
Account pay.
Revenue. We never recorded the receivable, so we can't credit it.
The payment for service at that time, not payment for service we already rendered earlier.
Right. Provide services and receive cash. So that would be cash sale. Pay the current month's rent of $1,300. Credit cash $1,300. Debit rent expense. Purchase office supplies on account for $1,000. Credit accounts payable, debit office supplies or office supplies expense. I'll take either one. Pay employee salaries of $2,100 for the month.
Credit cash.
Credit cash $2,100.
Debit salary expenses.
Debit salary expense $2,100. Let me change the last one. It's not in the book. Employees work during the month and are owed $2,100 in salary. Not credit cash. We didn't see the word pay, the magic word pay.
So no interest.
Not exactly accounts payable.
Salary due.
Salaries payable. We generally, and you might say, is there a big difference between accounts payable and salaries payable? And the short answer is, probably not. You have it in the liability section where it belongs, but it's the way things get into accounts payable in real accounting systems. Generally, it requires an invoice. When someone sends you an invoice or something that tells you owe the money, that's when you record an accounts payable. Salaries are going to be recorded through a different mechanism. Those things we record as separate payables because of the way they're generated. Rent is usually a separate payable. Interest is usually a separate payable. Income taxes are a separate payable. Salaries and payroll taxes are usually separate payables. If you put it in accounts payable, it's not the end of the world, but generally it wouldn't go there. Lastly, we had exercise 9. Here's where I give you the entry and you tell me the story of what happened or what the transaction was that caused us to record it. Debit equipment, $8,800. Credit cash, $8,800. Purchased equipment for $8,800 and paid cash. Debit accounts receivable, $3,200. Credit service revenue, $3,200. Provide services in the amount of $3,200 on account. Salary expense, debit $1,900, credit cash $1,900. Paid $1,900 in salaries. Debit cash, $1,500. Credit deferred revenue, $1,500. That's it. Well, actually, the deferred revenue doesn't come up much. We call it unearned revenue.
And this money that just happened across, like uncle dies.
No,
You didn't earn it, but it came in.
yeah, that's true, but there's going to be a circumstance that's a better description than dead
Cash
uncle.
come in, service wasn't provided yet.
We got paid. That's the debit to
You
cash.
received cash, service wasn't provided.
Service wasn't provided yet. So that happens a lot. If we're an online store and someone pays, we can't record the revenue until we've completed our half of the transaction. As a provider of goods and service, our half of the transaction is to ship or deliver the goods or services. So as long as we still have that to do, we don't have revenue we can record. It's a liability. So unearned revenue is a liability. Now, if we deliver the goods and services, we have revenue we can record, whether we've been paid or not. That's when we would record a receivable. So in this case, we debited cash. We credited an unearned revenue. So let's say we have a tax practice and we're doing a tax return for a client. They paid us in advance. We debit cash, credit unearned revenue. At some point, we're going to complete the tax return for them. When we do, we debit unearned revenue. And we credit revenue. Any questions about unearned revenue? A lot of companies have unearned revenue. Here's a couple of examples.
So in that scenario right there, had they paid us for something that immediately have been cash 5,000, revenue 5,000?
If we had got paid when we delivered what we needed to deliver, yeah. If they gave us the money and we gave them the tax return, debit cash, credit revenue. Since they gave us the money and we still had something to deliver, credit unearned. When we deliver it, we debit unearned, credit revenue. If you're a sports team and you sell season tickets, you've paid for the season in advance. That's all unearned revenue. As each game goes by, you recognize a proportion of that, what you were paid, as revenue. If you sell magazine subscriptions, you get paid for the year. Each time you send a monthly magazine, you take 1/12 of the revenue and earn it. So it moves from unearned to revenue. A couple of examples where it's common to see unearned revenue. Debit dividends of $900, credit cash of $900. Pay dividends of $900. Any questions so far? Seem fairly straightforward? We have some time, so let's do some more. What is the entry? Pay $700 for advertising for February. We're in February. Pay $700 for advertising. Credit cash. Advertising. Advertising expense. Purchase beauty supplies of $1,300 on account. We're a beauty parlor or salon.
Credit cash.
Not cash, on account.
Credit.
Accounts receivable, down payable.
Either debit supplies or supply expense, credit accounts payable. Provide beauty services of $2,900 to customers and receive cash. Pay employee salaries for the current month, $900.
Fire your employees.
Credit cash, debit, salary expense.
Yep. Provide beauty services of $1,000 to customers on account.
Credit account.
Credit revenue.
Yep. Pay utility bill for the month of $300.
Credit cash, debit, utility expense.
Yeah, I think you got the idea. Most of these just repeat each other. So any questions about what we did, the process, recognizing a transaction, making a journal entry, posting to a T account, balancing the T account, taking a trial balance, then making the financial statements? Everybody's good? Ready to move on? Okay. So next week we have chapter 3. This was chapter 2, the accounting cycle during the period. Next class, counting cycle, the end of the period. So have a good week, and I'll see you next Tuesday.
So,